Hey, my name's Josh Walker. I'm one of the owners of Arete Investing. Arete is a Greek word which means to live into your fullest potential, and that's what we're going to talk about specifically from a financial standpoint. Today's specific topic is accredited investors. So we're all about syndicated deals, investing in real assets, and a lot of these syndicated deals require you to be an accredited investor. So we'll define what that is. We'll talk about why it's required, and then what are some options to invest if you're not an accredited investor. So, first, let's talk about the specific definition of an accredited investor. So it's twofold. So it's an individual or an entity. So it can be a person, it can be an LLC, it can be a business that meets a certain financial criteria. One of those potential criteria are that you, as an individual or an entity, earn $200,000 a year as an individual or $300,000 with the combined income between you and your spouse for the past 2 years, and you reasonably expect to make that same amount or more in the current year. The other option that is completely separate, if you don't meet the first criteria, you can also meet the second criteria, which is that you have a net worth in excess of $1 million, excluding your primary residence. So if the house you live in is worth $2 million, but your net worth outside of that is $500,000 and you make $150,000 a year, you would not qualify. So if either of those two options that we discussed are true, you are an accredited investor. So why is this a thing? This is an SEC, a Securities and Exchange Commission's regulation, but why does it exist? So this is the SEC's way to, it's their attempt to assure that you have that you have sufficient financial resources to assume the risks that are associated with these kinds of deals. So their thought is if you have a certain amount of money, these deals can theoretically, they surmise, be riskier than other types of investments. That's extremely debatable, but other types of investments that they allow anybody in, like the stock market. And so we're going to set a bar a little higher to protect you from yourself. So, should this be a thing? First of all, it doesn't really matter. It's a thing, it exists. This is the world that we live in, so we will abide by these regulations. But just for fun, let's think about this. So I generally believe that you should have the ability to do whatever you want with the money that you earn. So beyond that, should the government get to tell you what you can and cannot invest in? Let's think about this. So one, they allow you to invest as much as you want and even borrow money to invest in individual stocks that you do not even have the ability to truly vet. Second of all, let's think about how the government is doing investing all of our tax money. I'll just leave that there for you to decide. The third thing is, does it make sense that just because somebody makes a certain amount of money, say $200,000 a year, does that mean that they are more qualified to invest an unlimited amount of money into a real asset that's run by another person? That's a loose definition of a syndication. That is certainly not the case. There are people who are extremely savvy in these kinds of investments that make $150,000 a year, and there are people that make $2 million a year that have no business investing in this kind of stuff because they don't know what they're doing. Somebody who makes a certain amount of money, maybe they have a little bit more of a buffer, but these numbers that are set by the SEC are somewhat arbitrary. They're an arbitrary line to draw in the sand as a threshold for who can and cannot invest in these types of deals. The bottom line is everyone should understand the risks that are involved with any investment. everyone should generally understand that these types of deals, specifically syndicated real estate investments, are generally illiquid. And what I mean by that is that when you invest your money, say you invest $50,000 into an apartment deal, and 6 months later, you decide you need that money back, that is very, very hard to do. It's not impossible. You would essentially have to find somebody else who is invested in that deal already to buy out your shares for an agreed upon amount of money. That's in relation to the stock market, which is extremely liquid. If you put $50,000 in today, you can pull out whatever the value of those shares are tomorrow or in an hour. You can make that trade. You pay some fee to do that trade, but you can put it in, you can get it right back out. That's not the case for syndicated real estate investments. So you can argue whether that's a great thing, whether it's not a great thing. Illiquid investments generally come with an illiquidity premium. What that means is if somebody is going to ask you to invest your money into something that you can't get back out for a given period of time, they generally have to give you a higher return than something that is completely liquid, or the risks should change a little bit because of the illiquidity of this type of investment. But at the end of all of it, you should do all of your homework and have the ability. I believe everyone should have the ability and the opportunity to adjust their risk profile as they see fit. But with all of that said, I digress. These are the current regulations, and we will abide by them and live within them, and hopefully they'll change. They are generally changing to, if they're moving in a certain direction, it is to allow more and more freedom to invest, for everyone to invest in these kinds of deals. I do believe that at some point in the future, who knows how long that might be, but at some point in the future, the vast majority of people will largely be able to invest in these kinds of deals. So, with all of that, let's talk about Regulation D. Regulation D is important to understand because it will tell you, it'll explain which deals require you to be an accredited investor and which deals potentially do not. So Regulation D is a part of the Security and Exchange Commission, the SEC's regulation governing private placement exemptions. So private placement deals are syndicated deals. So there are two types of syndicated or private placement offerings that you should become familiar with. One of these is a 506B, and one of these is a 506C. And the B and the C actually help to make it easier to remember what means what, and I'll explain that here in a second. So a 506B offering, that type of an investment cannot be advertised. A 506B cannot be advertised. It has to all be word of mouth or email distributions or private communication. Think of a private Facebook group, an email list with people with whom you have a pre-existing relationship. That's it. The sponsor is not required to verify that the investor is accredited. You can take their word for it. They generally have you sign a form saying, yes, I am accredited. There does not have to be a third-party verification. And the sponsor can raise an unlimited amount of money from an unlimited amount of accredited investors. And they can have, in a 506B, up to 35 non-accredited investors. These non-accredited investors must be sophisticated investors, which is that is a loosely defined term, which generally means that they know what they're doing. A sophisticated investor who's investing in a deal that's a 506B should be somebody who has a pre-existing relationship with that sponsor and they know what they're doing. It's up to the sponsor to determine whether or not they know what they're doing. So it's a very, very loose definition, but that is what a 506B offering entails. The way to remember this is B, I mentioned that it cannot be advertised. So think be quiet. A 506c can be advertised. So think 506c means you can see it. Everyone can see it. So these deals can be as publicly advertised as the sponsor wants. They can be on billboards, you can have commercials, you can put them on Facebook, you name it. They can advertise as much as they want, but they are only available to accredited investors. The sponsor, this is how this regulation reads, the sponsor must take reasonable steps to verify that every investor is accredited. So there are third party services that can verify your status. There are some places online where you can submit some documentation and they will do a verification and send you, which you can then send to the sponsor, a verification letter. Or you can simply get a letter from either your CPA or your attorney to verify that you are an accredited investor. So remember, 506B cannot be advertised. Got to be quiet. 506C can be advertised. You can see it. So there are other deal structures outside of 506B and C offerings that have much looser regulations. Those are generally joint ventures and private lending. So joint ventures are not considered a PPM. A joint venture is simply the pooling of everyone's funds into a deal in which everyone has equal rights to decision making and a proportionate share of the deal depending on how much money is put in, and that can be defined by that group of people however they like. But a joint venture, the biggest difference in a joint venture and a typical syndicated deal, in a syndicated deal you have the GPs, they do all the work, they make all of the decisions. The LPs or the investors can make none of the decisions. There are no voting rights. They do all of their research on the front end, and then they are along for the ride. And we talk about forever. There's no such thing as a good deal with a bad sponsor. You are completely reliant upon that sponsor executing an amazing business plan for you to get an amazing return. The other thing is private lending. So it can be, if it's in the form of a note, just think of a typical loan, and these can get extremely creative, but private lending is completely separate from 506 B, and C. So that's generally what it's all about. That's what an accredited investor is. That's why it exists. It's getting looser. We're moving away from this slowly but surely. I do believe that one day this will kind of get wiped clean and everybody will be able to do whatever they want with their own money from an investment standpoint as it pertains to syndicated deals. But like I said, this is the world that we live in and we'll abide by it. So if you want more of this kind of information, reach out to us. Go to areteinvesting.com. That's ARETE investing.com. Download your complete guide to syndicated real estate deals. That's got a ton of amazing information, and we would love it if you would rate and review and share this podcast.